Dear viewers, welcome to yet another edition of this Friday's Your Life, Your Money. In this edition, I'm going to talk to you about the guaranteed return insurance plan and why it merits a serious attention from all of you. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, there was a time when people used to say, do not combine insurance and investment. That's something which is bad. For a period of time, that was the truth. But is it a gospel truth that we should never touch an insurance product for the sake of investment? Probably I beg to differ here. We must always have an open mind and check if a product comes into the market, whether it meets attention. 10 years before, 12 years before, the insurance products were pretty bad. Then the new regulations came in the insurance sector that made these products very, very attractive. The product that we are going to discuss in today's episode is Guaranteed Return Insurance Plan and why it merits a serious attention from all of you. Investors always look out for plans which can give them a tax benefit. There were a lot of tax beneficial products in the past. You had the unit-linked insurance plans, you had the VPFs, you had so many products in the past which could give you tax break, including the mutual fund till 2018 were completely tax-free. Your gains from the stock markets were tax-free. All these things were there. But as times evolved, the government made sure that all these products came under the tax net. Today you have got the mutual funds with a 10% long-term capital gains tax. The same story holds good for investments in the equity segment. Unit-linked insurance plans, which were tax-free earlier, have also been brought under the tax net starting from the budget of 2020. Today you do not have many instruments which can give you tax-free status at maturity. When we talk about the taxation benefit can come in two places. One, when you invest your money into it, that's an ATC benefit that is still continues there with 1.5 lakh benefit. You have PPF, you have insurance premium, you can pay for the ULIP plans, your interest from housing loans, all this comes under the ATC. But that's a meager 1.5 lakh when you put in the money. The real interest of tax saving comes when the product matures. When the product matures, if it has a completely tax-free status, that is where you save a lot of money. If you evaluate the product with a post-tax return, what it is going to get, then things will become much easier for you to understand and take a proper decision should you invest in those products or not. I will not be saying anything wrong if I say guaranteed return insurance plans probably are the last instruments which are left, which are still not taxed at maturity. What are these guaranteed return insurance plans? When you go to the insurance sector, you have multiple types of product. You have a term insurance which does not have any cash component in it. It is meant only to give you insurance. You have an unit-linked insurance plans which are nothing but a mutual fund kind of an investment from an insurance company. Then you had the traditional old products like an endowment plan from an LIC or a money back from the LIC. These are the original plans. The endowment plans and the money back plans are the ones which really fall into the category of do not combine insurance and investment. Whereas when you look at a ULIP plan or when you look at a guaranteed return insurance plan, this statement of do not combine insurance and investment probably will not hold good. Sometime in the back, I had done one video with the title, Do Not Combine Insurance and Investment. It is a half truth. I'll give the link to this episode here on the card section. To know why this statement is not fully correct, please watch this video and be guided on that. What are the guaranteed return insurance plans? Guaranteed return insurance plans were not there before. These have come into the market sometime in last 3 to 4 years. It's a reinventing that has happened with an insurance company. How does it work? It's not a ULIP plan. It is not an endowment plan or a money back plan, what you saw in the earlier years. It is not a term plan. It's a category by itself. It works in a simple way. This is a product, it is not being bought for the sake of insurance. Many people think, oh, to get so much of an insurance, I have to put so much money. No, this product is a pure investment plan. It works in a simple concept, like let's say that you want to invest a lakh of rupee per year. Then the product automatically gives you 10 times more or more than that as per the calculations that the insurance companies have set in. That gets packed into this. So you don't work from the endowment plan base, wherein which you say, I need 1 crore of insurance, how much is the premium I have to pay? That's an endowment plan. Whereas here, you just look at what is the amount of money that you want to invest, and based on that, it will simply calculate this is the insurance which gets packed into it. Insurance is an add-on here. The real component is the investment part of it. And why it becomes attractive? Because when the 10 times insurance is added onto this investment plan, then the output, the maturity value or the cash flow you derive from these particular plans will become 100% tax free. That is where the real attraction of these plans lies. To understand this product, a simple way is to look at your bank FD. These plans literally look like a bank fixed deposit, or to be precise, it looks like something like a bank RD account. But there is multiple advantages than a bank FD or a bank RD. During this course of this video, I will talk to you about how they differ from an FD and why they are far, far better than your bank fixed deposits or an RD account. How are these plans designed? These are extremely customer-centric, customer-friendly plans. The way it works is very simple. You decide how much money you want to invest in this particular plan. Then you decide how long you want to pay for this plan. You decide the amount, you decide the tenure. Then you decide how do you want the maturity amount. Do you want all the money in one day, or do you want it over a certain number of years? You want it throughout your life. So there are various features which are put into it. So you decide how the output has to be. That's the way the plan gets designed. It is designed as per your needs. You can see how you can fit into this particular plan. It is so user friendly. One grouse with insurance product is they generate lesser rate of return. Is it the truth? The answer is no, this is not the truth. How much is the return the guaranteed rate insurance plans are getting? The return from insurance plans are measured in terms of IRR, internal rate of return, which is something which is similar to a CAGR, compounded annual growth rate. There was a time the insurance products were giving less than the bank fixed deposit rates. Interestingly, in the last 3 years, when the interest rates were low, these guaranteed return plans were paying literally 1 to 2% more than the bank fixed deposit rate. Thanks to the rise in interest rate today, the guaranteed return insurance plans are more or less giving you same rate as a bank fixed deposit or slightly higher than a bank fixed deposit for longer tenures. If I look at different plans which are existing in the marketplace, the IRR in these plans work out anywhere from 6.5 to 7% completely tax-free. When I say 7% tax-free, you may suddenly lose interest. Oh, 7%, what big deal is this? 7% on a guaranteed return is not small. See, look at the things which gets packed into it here. When you think 7%, it is 7% is not small. It is a post-tax return. You don't pay any taxes on this, so you will get 7%. Can I compare this with a bank FD? Yes, we can compare it with a bank FD. Let's imagine that you have got a bank fixed FD, which gets you 10% interest rate. And you are in the highest tax bracket, which many of our customers, and there are countless people who are in the highest tax brackets today. So if you get 10% on the bank fixed deposit and you pay 30%, in fact it's going to be more than 30%, you are left with post-tax return of 7% or still lesser than the 7%. So a 7% tax-free return, what you get from these particular plans is equal to a bank fixed deposit rate of taxable 10%. What is the probability of India touching the fixed deposit rate of 10% in the near future? The probability is almost zero. Unless somebody really messes up and things really go wrong, I don't think 10% FD rates India will ever see. Let me assume for a while that okay, India will get 10% FD rate. What is the probability that this will remain at 10%? permanently throughout your life? The answer is 3 times 0. So it's not possible. A developing country will always have a lower interest rate. That's a normal course it will happen. You look at where the developed countries are. Yes, right now they are going through an inflationary pressure, but for the last 15, 20 years, their interest rate was close to 0. What happened in case of China and so many other countries? So India will not have a 10% fixed deposit rate throughout your lifetime. So once you know that the return from these plans are equal to a taxable FD rate of 10%, to decide on this product, to subscribe will become very, very easy one. It's not a rocket science. So if you apply a common sense, it says yes, it makes absolute sense to invest in these particular plans. One of the questions people ask is the plan liquid? What is the liquidity in the plan? If I need money, can I get it? The answer to this question is these are liquid as well as these are non-liquid. These are not designed as liquid plans as such. It's not something like that you have a bank fixed deposit. Tomorrow you go to the bank and say that I need the money, and you cancel your FDs and you get all the money back. That's not the way it is designed. It's an illiquid plan. But in the event of extreme circumstances, things going out of control, and your life will be put into difficulty without the money which is put into this plan, still the liquidity is given in the form of either surrenders or pre-closures at the payout period. The surrenders as such will always have a penalty. You can't get a guarantee for life and you have 100% liquidity. That will not happen. See, if you are looking for a guarantees for a lifetime, it will also have some other disadvantages as well. So you can't create a product which has 100% liquid, which is 100% tax-free, which will have guarantees throughout your life, which gives you high rate of return. All these things cannot be planned together. But you don't have to have a fear that, okay, my money is going to get locked over there under extreme duress, I'll not get this money. No, you don't have to fear about that. The provisions are there in these plans to liquidate the plans, of course, with a cost. I told you in the beginning, these products resemble like an FD, but it has multiple advantages over the bank FD. It has multiple advantages, mind-boggling advantage over the bank FD. Let's look at a bank FD with different parameters now. When you put your money in a bank FD, the interest you get is taxable. Whether you take that money out that year or you allow it to compound itself in the bank FD, at the end of the year, you have to take an interest certificate from the bank and add that interest in your income statement. That means whether you get 4%, 7%, 10%, the interest is taxable. In this particular product, it will not be taxable. That means it is 100% tax-free. Now, what is the second advantage? The second advantage is, let us look at the disadvantages of a fixed deposit. In a fixed deposit, the bank can give you a guarantee for a maximum period of 10 years. You put the money today, interest rates are very high, the bank will give you, let's say, 7%, and you ask the bank, give me this interest rate for next 30 years, bank will not give you. Bank will give you guarantee only for the next 10 years maximum. Whereas in this case, the guarantees will run for as long as you run the plan. The plan can run for 10 years, 20 years, 30 years, or your lifetime. The guarantees will continue. In case of a bank FD, you run a reinvestment risk. Reinvestment risk is you park the money in a bank FD for next 10 years. What happens after 10 years? After 10 years, you have to renew this FD at the prevailing interest rate. What is the probability of interest rate being higher than 7% 10 years down the line? Extremely meager chances. As a developing country, the interest rates will obviously fall down. The current thinking is probably within the next 5 to 7 years max, India will have a new FD rates of 3 to 4%. It is inevitable. It is inescapable. So you invest in this particular plans and lock in this attractive interest rate for rest of your lifetime. It doesn't need a great decision making. It's very simple. These products will also score over FD on one another parameter. Let's say that you walk into a bank and say, I want a rate of return guarantee for next 10 years. I'll put 10 lakh rupees today, but I'll put another 10 lakhs next year, another 10 lakhs next year. I'll put every year 10 lakhs. Give me the rate of return guarantee now. The bank will say, I will give you the guarantee for the money you deposit in the bank today. But what rate of return you get? Next year when you bring the money, it depends on whatever the rate which is prevailing next year. It could be higher or it could be lower. So a bank can give you rate of return guarantee only when you deposit the money. Whereas in this case, you pay a token amount of money. You put one installment of money this year and you get into a contract to pay for it over the rest of the years as per your contract that you get into the insurance company. You still get the same rate of return. That means it works like a reservation ticket to get a better return for rest of your life. Imagine a situation, today interest rate is at 7%. Imagine if you have a fixed income instrument which gives you 10% tax-free return today. Will you feel happy or will you feel, oh, I bought an insurance product? You will obviously feel happy because interest rate is 7%. You have got into a product which gives you 10% sometime in the past and you are enjoying it. Imagine a situation 10 years later. The bank interest rate will be 3 to 4%. It is taxable. Now you have got this particular product where you don't have to pay any taxes and you continue to get 7% for as long as you want, or as long as you have designed this policy, you will feel absolutely happy that you have taken this particular plan. The success in any planning will come from how do you judge the future. It's not about how do you judge your situation of today. How do you prejudge what might happen in the future and take a decision today that creates the best of the best planning in your life. One question that comes to mind of investors is, I am parking money in an insurance company. What is the safety for my money? It's an obvious question. It's a genuine question. Every investor must ask this question. In fact, the money in an insurance company is more safer than the money which is there in your bank. When you give money to a bank, you are lending money to a bank, and a bank relends this money to another business, and the ability of the bank to pay back that money depends on its ability to collect that money back from its lenders. What happens in case of an insurance company? Insurance companies can give you guarantee because they invest this money in the government securities, government long-term bonds. Most of its money will go into government long-term bonds. They may invest in some other securities as well, but they can give long-term guarantees only when they park the money in the long-term bonds of the governments. Government cannot default. It has the ability to print money. So your money is absolutely safe. The insurance companies will never lend money to a business. They lend money to government or they invest money in the bonds. Your money is absolutely safe. Insurance companies will never go belly up. They are regulated. They are regulated by IRDA. You haven't heard about one insurance company in India which has gone bankrupt. One of the recent examples where we noticed that the insurance company went into trouble was Sahara Life Insurance. But did the policyholders lose money? No. Sahara Life Insurance was merged with another company and the policyholders' interests were protected. So you have nothing to worry about if you are investing in an insurance company, irrespective of its name, irrespective of the brand. It's a regulated industry and your monies are quite safe there. Now let us examine who can use this plan. The real attraction of this plan is a tax-free status of return, a rate which is higher than the bank, a rate which is guaranteed for the length of the policy or lifetime guarantees if you opt for lifetime payout. That's the attraction. These are the three attractions. Guarantees for life, tax-free status. Now let's see who can use it. If you're 45 years and above, and if you want to create a retirement income, then this is one of the finest method to create a retirement income. In fact, the cash payouts from these plans are higher than the annuity plans itself. Annuity comes under taxation, whereas these cash payout from this particular plan is tax-free. Most people, every person for that matter, derives comfort in their life not from the investment that they have made. They derive comfort from the salaries that they get. They have an active income month after month. This money comes and falls into their bank account. That is where their comfort lies. But when you retire, this comfort is taken out. Whatever could be the amount of money that you could be having in your bank, I have seen during my career, when you do not have an active income, people will feel fish out of water. This plan gives you that comfort of getting every month money in your account throughout your life. It's just not your life. You can make it in such a way that you and your wife both get this money throughout your life. That's the comfort this plan can create. If you are a retiring person, make no mistake, you feel free to lock into the returns which are there in this particular plan. This plan gives you the tax break, as I said. So if you're a person who is working now and you are saddled with excessive income tax, you are in a high tax bracket, instead of keeping money in the bank fixed deposit or making a bank RD accounts, it makes sense for you to subscribe to this particular plan. This is another category. The third category could be you are a youngster. You have an income right now and you are a person who invests money in the bank fixed deposit. You want to create a second income maybe after 45 to 60 years of age. That is where you will pass through the peak expense period of your life. Your children are growing, educational expenses, several expenses can come. You can make use of this particular product to create a second income which is completely tax-free. These are the three categories of people who can effectively use it. People who want to create a retirement income, people who want to save on the taxes, people who want to create a second income can effectively use these plans. One another category which can effectively use this plan is the returning NRIs. As long as you are an NRI and if you are maintaining NRI FD, it is tax-free for you. You still have the reinvestment risk, but when you come back to India, it has to be redesignated as a resident FD. That means you will be paying through your nose the taxes. If you are thoughtful, if you are proactive, this is a time, if your coming back to India is visible to you in the next 5, 10, 15 years, probably you should take a call on this particular plan and lock into the return and save yourself from paying the taxes when you come back to India. You may ask the question, which companies have got these particular plans? Almost every company has these plans. I do not take the liberty of mentioning any specific names. I'm not supposed to. And it's not advisable also, because while selecting the plans, a careful evaluation of the plan as well as evaluation of your life and your suitability. So I'll not take any specific names here. It is suffice to say every insurance company has similar plans. If you decide to buy these particular plans, what is the care that you should take before you buy this plan? The first care that you have to take is you need professional assistance to buy these plans. You must first check whether these plans are suitable to you or not. Don't get emotional and say that I'll go and buy this particular plan. Please do not do that particular mistake. Instead, visit a financial planner or your financial advisor or people who know about this particular plan, take their help and look at the suitability. If you have an advisor, take their help. If you do not have an advisor and you want professional assistance to select these particular plans, you can make best use of our services as well. Our number is shown here on the screen. You can reach to us through a WhatsApp message from any corner of the world. People who are working with us will help you to decide on which plan suits you, which features suit you, how you have to decide. All these professional requirements are taken care, and we'll make sure that you will be able to zero in on the right product. While you subscribe to this particular plan, one another care that you have to take is, apart from the suitability to your circumstances, you should also tie up the cash flow. There are people who subscribe this with a high level of subscription, 5 lakh, 10 lakh, 15 lakh, 20 lakh, 25 lakhs. When you opt to pay for next 5 years, 10 years, 12 years, you should tie your cash flow, which means to say, in case if you don't have a job, from where will the subscription money is going to come from? You have to make proper calculations. The best thing is take the services of the advisor, and they will go through a fact find session and find out your assets and liabilities, where your cash flow is coming, and they will be able to assist you with what is the right amount you can put on this particular plan. Likewise, you have to choose the right plan, and within the plan you have to choose the right features, the right payout options, and all these things depends on assessment of your life and assessing your individual circumstances. Only based on that, the right product can be recommended for you. When these plans came into the marketplace, what are the common objections that were heard? The first objection was do not combine insurance and investment. I don't take this dogma very seriously. When you have an open mind and when you evaluate this with your common sense, you will find the answer. So it's not a dogma or it's not something that a Lakshmana Rekha that you have should not cross. As long as it is beneficial to you, as long as it fits your requirements, circumstances, it is suitable to you, there is nothing wrong. You are not governed by that particular saying there. One another common objection people say is the cost of insurance. The cost of insurance is not something which you have to worry in this particular plan because it is not something which is added separately and taken out from your return. When you subscribe to this plan, everything is predetermined. How much money do you pay? How long you pay? How much the insurance company is going to pay? Everything is in a contract. It doesn't vary. So it is not something which you have to really worry about. Cost of insurance will not bring down your returns. Everything is guaranteed. It just doesn't vary. It exactly resembles like a fixed deposit. Another objection is my money is going to get locked. There is no liquidity. This point also I've already spoken. Yes, it's an illiquid plan, but it is not so illiquid like a real estate that you struggle to get out of this. No, there are surrender options are available. Pre-closure options are available. That's not something that you have to really work about. And illiquidity is part of many instruments. If you put money in a PPF account, that is illiquid. You put money in an NPS account, it is illiquid. You put money in a real estate, it is illiquid. So there are illiquidity is there in many of the instruments. So it is not something that because it is illiquid, you should not touch it. It's untouchable. No, that's not the way to look at it. One another common objection people make is that it will not beat inflation. It need not beat inflation. As long as it stays in line with inflation, that's also is fine. Or even if it falls slightly lesser than the inflation, that's also is fine. You keep money in a bank and you pay the taxes. Right from beginning, your value of money keeps coming down. Not a single year I have seen in the last 30 years. If you have kept money in the fixed deposit and if you are a taxpayer, your erosion has not happened. But that did not prevent you from keeping money in the fixed deposit. See, understand, no fixed income instrument will beat inflation hands down. That is what the mutual funds will do. That is what the stock markets will do. That is what the AIFs might do. But they also have the other drawbacks. See, for example, your return in a mutual fund is not linear. Your AIF may lose money. All these the negative sides are also present in such kind of an instrument. Finally, in your financial planning exercise, what is required is both debt and both mutual fund. So neither mutual fund is complete nor the debt instruments are complete. Only when you are able to combine these two, then you will combine the stability with the growth. So just because it is not something which is beating the inflation, you should shun away from it. That's not the correct assumption. And these particular products have a role to play in your financial well-being. One important point that you have to keep it in mind is there is a sense of urgency with this particular plan. As I said, the government of the day will not allow any chance for a high net worth individual to escape the tax net. They have taxed the mutual funds, they have taxed the unit linked insurance plan, they have taxed the BPF accounts where people had a lot of tax arbitrage around. This is the only plan which is still not taxed. Why it is not taxed? I do not have the answer. I was talking to a couple of CEOs in some of the conferences and I asked them why government has not taxed this plan. The answer that I got was probably that they are concerned that the valuation of the insurance behemoth which they want to privatize might fall if those plans get taxed. That could be the reason why government has not taxed, or government might have an intention to tax these plans in the next budget, which is in the February. So there is a sense of urgency here. If government notifies this plan or put a restriction that, okay, I'll allow up to 2.5 lakh only in this particular plan. If you put more than that, I'll bring it under the tax net. That's a perfect possibility. So if you have an intention to buy into this plan, do not lose time. Contact us or contact your advisors and get started with this particular plan as soon as possible. Don't wait till the next budget day. One question that could be there in your mind is, I buy this plan today, why cannot government tax the plan in future? Yes, you have a point. Governments are supreme. Government can do what they want. But retrospective taxation is not good governance. No government will do that. See, for example, in the case of mutual funds, till 2018, these plans were completely tax-free, the mutual fund investment. When the taxation came in, they grandfathered the gains that you have made prior to that. Only taxation came on the future gains you made post the announcement date. Likewise, in case of unit-linked insurance plans, all plans purchased before the budget of 2020 still continue to enjoy the tax-free status. So if you buy into this plan now, and if government notifies these plans in future, you don't have to worry about the plans that you have purchased today will come under the taxation. It's almost certain that the government will not tax the currently purchased plans. Dear viewers, hope the video that I have done today helped you to understand the merits and demerits of guaranteed rate insurance plan. Please like this video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for the channel, please hit the subscribe button and press the bell icon. Don't forget to share these videos with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall see you next Friday with yet another episode of Your Money, Your Life. Till then, stay safe.
Press the bell icon for more details and subscribe our channel.